Sanjay Sinha, founder and Chief Executive Officer of Citrus Advisors. Morning, Sanjay. Thank you for joining us. Sanjay, in this calendar year, Indian markets have appreciated very, very quickly. Do you think now Indian markets are looking slightly stretched and they are running ahead of themselves?
Nikunj, what normally happens is that the market valuations at any point of time is very relative. We have seen that the markets came to the lows of 2011 because of the downgrades that followed after the market had moved down. I think what might happen in 2012 is that the upgrades to the Sensex earnings estimates may come towards the later part of the years, and the markets may actually run up ahead of that. Because today, I think what is influencing the market in a more pronounced manner is not so much the fundamentals of the market but the technicals. This specifically I would say that refers to the way the liquidity is chasing stocks. Look at the psychology of the market, which is extremely pessimistic. Look at the broader view, which is almost unipolar, that the markets would rally only in the second half of 2012 and not in the first half. A combination of all this, I think, has created a situation where the market has every chance of moving a little ahead of where we are today before we actually take a sanity check.
Sanjay, you think the market is going to give that opportunity ahead of the budget in anticipation of what may come about? Or do you think it is going to only react post the event and then take it higher from 5,400?
I think before the budget, the markets may react more to the politics of the country. We have some very significant state elections results to be announced even before the budget is presented to the parliament. And I think the most important result that the markets will be looking at would be the UP composition of the seats post the election. In my own view, I think that for the BSP to repeat a 206 seat performance against an anti-incumbency factor is going to be very difficult. And for a Congress to repeat a pathetic performance of 22 seats is also going to be extremely unlikely. So Congress is obviously going to improve from where they are today, and this will be taken as an endorsement for the UPA government. So this would be the first event which I think the market would react to. And following this, I think the budget expectations and the actual budget announcement would be the second factor that the markets may react to.
What is your overall market approach? Are you going to be more defensive in terms of your sector positioning from here onwards? Or would you still stay put in beta and you think that is what is going to lead the market higher from here?
I think 2012 will not be the year for the defensive stocks as 2011 has been. Because I think the primary driver or the primary theme that will influence a broad number of sectors would be the decline in the interest rates and a broader improvement in the business environment. And therefore, I think three prominent sectors which will be in the reckoning would be number one, banking, number two, automobiles, and number three, infrastructure, which under this umbrella would include capital goods, construction, and the other related sectors. Having said that, I think no portfolio can be lopsided only in one direction, and therefore there will still be room for some of these stars of the last year, which is FMCG and pharma, to be part of the portfolio. And I think the way the IT sector has been able to maintain the volume growth, they have faced certain amount of turbulence because of currency, but the volume growth has been quite intact, and I think anything around 15% volume growth year on year, in my opinion, is quite impressive. So this would be the combination of sectors which will be part of the portfolio.
So what is on your avoid list? Because you like FMCG, you like IT, you like pharma, you like infra, you also like banks.
Yeah, what I don't like this year is metals, because I think what is a likely possibility is that given the fact that US is surely going to slow down, the sort of run in commodity prices that we have seen over the last couple of years, that run will not be repeated. At best, what they can do is hold on to the prices. If that be the case, and you do not have impressive volume gains coming in the favor of metal companies, then 2012 would be a year to avoid this sector.
Which means you like 80% of the market, Sanjay, and you don't like only 20% of the market, which is broadly commodities.
The market capitalization of the market and the actual choice of the portfolio may not exactly be related, because you do not normally, if you do not have an index-based strategy to invest, you may not necessarily be replicating the market. This I say more in the context that 2012 will also be the year in which you will see the mid-cap index outperforming the large-cap index, and therefore if you look at the relative weights of market capitalization, roughly about 10 to 15% of the market cap at best is captured in the mid-cap segment and 85% in the large cap. But I think this year, if you have a larger weightage to the mid-caps, your portfolio will do better.
Sanjay, cement is always considered as a proxy to a country's economic growth. At a time when Indian economy is slowing down, why are cement stocks outperforming?
I think for that, you need to travel outside the metropolitan cities and see what sort of massive construction activity is happening in the tier 1 and tier 2 cities. I think the domestic consumption story is very much intact even in the so-called economic slowdown. And mind you, 6.9% GDP growth is not a slowdown actually. It's only a relative growth that is not comparable to the 8.4% that we saw in 2011. So I think that is very much intact, and I think going forward, this is only likely to accelerate because, there is some sign that the government's policy paralysis is somewhat now coming down and the government is coming on the front foot as far as the project announcements and the award of projects are concerned. So I think this will also be a factor which will contribute not only to the broader economy but also to the cement sector in particular.
Your thoughts on telecom as a pack, and more importantly, what would you do with the Bharti right now in case someone actually already has it in their portfolio?
I think, the worst probably is over as far as the telecom pack is concerned. And I say that because of, a combination of events which have happened over the last few months. I think all the negative sentiments that had congregated on the 2G spectrum allocation, I think with the Supreme Court verdict, good or bad, at least it is now out in the open, and therefore that issue stands resolved. What is the outcome of this verdict is that the industry is now likely to see more consolidation rather than spread across a large number of players. Coupled with this is the fact that, in the Delhi circle, the telecom companies actually revised their minutes usage charges by almost 30% in a single go. So this, in my opinion, has brought the pricing power back into the sector. With this, now that we will have another round of the allocation and we will probably now see some stability, and coupled with that, the long-awaited telecom policy should also be in place. I think all this in combination means that the telecom sector now needs to be looked at a little more positively than what we have done over the last 1 year at least, if not more than that. And therefore that's, for me, a sector to be looked at with a positive outlook. With reference to Bharti in particular, I would say that, the events that have, the fact that, their foray into Africa at this point of time does raise some concern about how profitable that is. But overall, I think it's a company that would be one of the leading participants in the telecom pack.